Hello and welcome to a brand new episode of Smart Money. As we enter the last week of the year, let's take stock of some of the best mutual fund managers this year. Undoubtedly, one of the best performers in the mutual fund category has been Quant MF in the last 1 to 3 years. Just to give you some numbers, the Quant Small Cap Fund has delivered 46% return in the last 3 years, while the basic Flexi Cap Fund from Quant has delivered 33% in the last 3 years. So what are they doing right? How does one generate these kind of returns in your portfolio? And what's the secret sauce to stock picking? Sandeep Tandon, the founder and CIO of Quant Mutual Fund, is here today for our year-end Smart Money special. Sandeep, thank you so much for joining us on the show. It's great to have you here. You know, all your schemes have given great returns in the last 3-year horizon, if you look at it. Just wanted to start by asking you, what is the mantra behind your success?
So, if you look at and understand our investment thesis, it is basically rely on active, absolute and unconstrained. Okay. When we talk about active, yes, we manage very many dynamically. We take a fees of active money manager, but industry deliver most of the time passive products. Okay, so we are very, very active. And if you look at, we call this era is, this whole decade belongs to active money manager. Last 10 years was more from passive, which has grown. Then we talk about absolute. Okay, so when you take money and talk about certain IRR, certain timeline, but over a period of whatever reason markets are bad, you say, I have outperformed the market, but actually you have delivered the negative returns. Okay, how to address this problem? So we try to focus on absolute return. It is an endeavor to generate absolute returns. Okay, and third thesis is about unconstrained style. We are style agnostic, market cap agnostic. We are pure opportunist. Wherever we see better risk-adjusted opportunity, we try to play on that. Let's understand when we talk about absolute return, how we manage our money. We manage like any corporate, if you look at this treasury income. Okay. Now you don't expect the end of the quarter, the treasury returns should be negative. Okay. The management expect the treasury return should be positive. Okay. How they manage. So this is exactly we manage our money like a treasury. We look at from a decadal view, long-term view, medium-term, short-term, near-term, hedge call, cash call, special situation. So we try to manage all the risks simultaneously. Okay. And if you manage your short-term and near-term risk better, you not only protect the portfolio, but you actually generate alpha out of it. So that's the way we define our performance, because it is a continuously effort to generate alpha. Small alpha add up a good alpha over a period of time. And the great thing is about we manage our risk better.
Momentum investing is something that you're very keenly focused on, right? So which are the sectors you think are at an inflection point right now where one can sort of jump into?
So just to address that, we are not a momentum house. We actually identify stock and sector which are trading on the extreme inflection points. Okay, when I say extreme, either there's a euphoric move on a stock or sector, when it peaks out, we exit, or when you see a capitulative move. Okay, when stock hit or sector hits the lowest point. Okay, so it's from admired territory to neglected territory. When it start trading, when try to capitalize. Let's say 6 months back, in month of March, February, March, the entire pharma sector from deep admired territory, which was in the COVID phase, got into a neglected zone. So that's the time we build huge exposure in the pharma space. Few months later, it was metals. Okay, and everybody was concerned about China, dollar index rally, and we built a very large exposure because metals mining as a sector was in neglected phase. Okay, then that cycle played out very well. Even look at the public sector enterprise. Okay, for a decade sort of thing, maybe in 2021-22, we saw extreme inflection points in the public sector stock, and now look at the darling of the markets. Okay, so they were in extreme. If you ask me, the public sector stocks have peaked out. They have got into admired territory. Answer is big no. Okay, they yet to reach the admired territory. Till the time we'll able to capitalize. Media is another sector which was still traded in the from the same industry. It was a deep neglected zone. Nobody wants to even touch or talk about media sector. So you tend to identify these opportunity or sectors, and then you generate a massive alpha out of it, provided if you get that cycle right and you get in the extreme inflection point. The advantage of extreme inflection point, your downside is protected. No, not much downside is there. Similarly, if you sell at the peak of the cycle, when you see a euphoric move and stocks are trading in the most admired territory, upside is capped. So it's better to prune exposure at that moment and rebuild exposure in the neglected. So we try to capitalize on the extreme point, but it's not easy. Okay, like now in a bull market, you don't get those neglected zones so easily.
So what do you feel is a sector that is still in the neglected zone and there's still a lot of time for it to reach the admired territory?
I think pharma is still in the very early stages. Okay, pharma cycle has just started few months back. it still has potential. The cycle can last maybe few more years. If you ask me, same thing I said for public sector enterprise. They are no more in neglected zone, but public sector enterprise yet to reach our most admired zone. So once they reach, I don't think it has some time left for the. So is the case with public sector banks also, relative to private sector bank. They have some steam left. Okay, metals and mining, most neglected zone, most hated sector. Nobody wants to even touch the public sector stock. Nobody wants to talk about mining stock, metal stock, China factor, dollar factor, DXY factor. I think you look at the moves, and if you ask me, it's just a beginning. Okay, grossly under-owned sector, and I think when you get a sector or stock in a neglected zone, and have completely under ownership, then the upside is pretty large.
Okay, that's very interesting, and that's something that our audience can take away as well. Find sectors which are in the neglected zone and jump onto them, right? Sandeep, you had mentioned once that equity as an asset class is typically viewed as suitable for long term, although this may not necessarily be true for stocks or for the portfolio. Can you elaborate more on this?
Yeah. See, when we talk about equity as an asset class or investor, okay, equity investor, they are long term. Okay, when we talk about sector and stock, not necessary. Okay, this is a myth when we say you buy stock from a longer term perspective. The people have grown. See, when you are in the very infancy stages of the market, early stages, like India was emerging market, that thesis will work very well. Okay, but if you really look at from a longer term perspective, what is very important is that asset class long term, investor is long term, and stocks and sectors are not long term. Okay. So this is a mistake which people do. People get associated from a longer term perspective, and sometimes industry dynamics change completely. Okay, and you don't get exit. Okay, so we play our thesis on the money flow analytics. We try to see how the risk appetite and liquidity of the sector is changing, and if it's changed, then we try to take a call on that. Okay, let me give you a small example. Today, whole world talks about valuations are expensive. Yes, valuations are expensive, and people give example what happened in 2018, what happened in 2007-8, but if you look at one unidirectional approach, valuation look expensive. But when you look at the multidimensional approach, look at when this type of valuation was there, what was the risk appetite for Indian stocks? Okay, what was the risk liquidity for the Indian market? The dynamics is completely different. So when you look at the three-dimensional approach, looking at the liquidity aspect, risk appetite, which is sentiment, and then look at the valuation, if the trinity is proper, then you get an answer. Otherwise, just saying in isolation, saying valuations are rich, and that's the reason most of the smart people have missed out this rally.
So I have two questions here, just follow up, because you spoke about valuations. What do you do with stocks like, say, a Varun Beverages, right? It's been a consistent performer for the last 5 years. Valuations were expensive 3 years back. They were expensive last year and today as well. But business is solid, promoters are solid, growth is good, it's a good industry. Do you hold on to stocks like this or do you churn out?
So instead of answering on Varun Beverages, I will say, let's look at the data points. Okay, if valuations are expensive, let's say classic example for any stock. Okay, look at Titan. Let's say the most admired category stock. Okay, a Titan valuation were expensive few years back also, but risk appetite and liquidity has yet to peak out. They have not peaked out up to that extent, and hence we are not taking a call that one should exit. We don't own it. That's a different issue. Okay, but purely from an understanding perspective, when we look at risk appetite spiking, liquidity shooting up, valuations are rich, that's a time I will say it's a combination. We said now we hit the most admired zone. Okay, unless that happens, we don't take that big call. Okay, now if you look at example like all private sector banks in January 2020, if I have to say that, they were trading, all were trading in the most admired zone, whether HDFC, Kotak, ICICI, entire private sector bank. Okay, it was qualifying that characteristic. But come September 2021, it got into a neglected zone, and then you saw next. So if you really look at 2 years, bank didn't perform. Okay, now again the same problem, over ownership. So you have to look at the combination aspect. Don't just look at the valuation. Valuation will not give all the answers.
Okay, this is very helpful and some sane advice. We have to take a short commercial break, but I'll come back to you in just a bit. Don't go anywhere, folks. Lots more discussions on how to build your corpus, how to look at a good portfolio in 2024, what are the red and the green flags before you pick a stock. More on that in a bit.